Welcome to the Deep Dive, where we grab a stack of source material and unpack the most important insights just for you. Today, we're diving into the fascinating world of angel investing. We're pulling key insights from the book Angel Investing, the Gust Guide to Making Money and Having Fun Investing in Startups.
That's right. And this deep dive, it's really built around a very practical guide. It's full of wisdom from, seasoned investors, entrepreneurs,
Right.
and it weaves in personal stories too, perspectives from people like Reid Hoffman, David S. Rose, big names.
Our mission is pretty simple. Just distill the essential nuggets from these sources, give you a clear path to understanding what angel investing actually is, how it works, and maybe what matters most if you're curious about this whole space. So let's jump right in. The book starts with the basics. What exactly is angel investing, according to what we've read?
Okay, so at its core, it's about individual people, not big firms, not institutions.
Just regular folks, well, maybe not regular folks, but individuals.
Individuals, yeah, using their own personal capital to invest in companies that are very, very early stage startups, basically.
Okay, so it's individuals putting their own money, their own cash, directly into a brand new company, often before it's even, launched or has real revenue.
Exactly. Personal funds, and crucially, doing it right at the beginning, very early in the company's life cycle.
And the sources, they make it really clear right away. This is risky, seriously
Oh,
risky.
absolutely. The book doesn't pull any punches there. It says the large majority of these early stage investments, they fail completely.
Wow.
Yeah, this isn't like putting money into, IBM or some mature public company.
A large majority fail.
Mm.
That statistic alone is pretty startling. So how do angels even approach that kind of risk?
Well, that high failure rate is precisely why the sources really hammer home the importance of a portfolio approach.
A portfolio, meaning,
Meaning, because any single investment is actually likely to fail, angels try to invest in a significant number of companies, ideally somewhere between, say, 20 and 80.
20 to 80 companies. That's way more than I would have guessed. What's the thinking there?
The goal is just to spread the risk, spread it wide enough so that the losses from the ones that inevitably fail are hopefully more than offset by the gains from the few winners.
Oh,
You're basically betting on a few big home runs to cover a lot of strikeouts.
that makes sense. What about the size? What's the typical size of these investments the sources talk about?
The average check from an individual angel, it's around $25,000 per company. But often, maybe 5 or 10 angels will team up, pool their money for a round.
Right.
Back in 2009, there was a survey. Angel groups averaged total rounds of about $275,000. But the trend now is for groups to collaborate more, syndicate deals to raise bigger rounds.
And what if someone's just investing on their own, solo?
A solo angel might put in, anywhere from $5,000 maybe, all the way up to $500,000 or even more in some cases.
Oh, wow, big range.
Yeah. And the book also mentions super angels. These are often people managing small funds, kind of like micro VCs, but still focused on that early stage. They might average, say, $100,000 to $200,000 per investment.
Okay.
You generally only see those really big early stage checks, like close to $1 million or more. When you get into the larger venture capital funds, they're structured differently.
Got it. That clarifies the scale.
Yeah.
Now, beyond the numbers, the sources have some really insightful personal stories about who actually becomes an angel investor.
Yes, that part's fascinating, the human element. We get a glimpse into the journey of someone like Reid Hoffman.
LinkedIn founder, right?
Yeah, exactly. He describes seeing the internet evolve into what he called the network age. So after co-founding LinkedIn for the professional side, he started angel investing in companies focused more on the social web, like Dig, Facebook, Flickr, Zynga, companies like that.
And his approach wasn't just about chasing quick trends, was it?
No, not at all. He really emphasized taking a long-term view, understanding that these companies were building relevance over years, maybe even decades. As the internet just got woven into daily life, he apparently backed over 100 companies in about 10 years.
Incredible. We also hear from David S. Rose, who has a pretty unique background himself.
Oh, absolutely unique. He thinks he might be the world's only third-generation angel investor.
Third generation.
Yeah, inspired by his grandfather and his father, Daniel Rose, who was actually an Ernst & Young Entrepreneur of the Year. So it's in the blood, apparently.
And David S. Rose. He had his own intense entrepreneurial journey before becoming an angel.
Definitely. He started tech companies while he was still in real estate, then went full-time into tech, even got VC funding back in the early 90s. And then the dot-com crash hit. He says it basically wiped out a decade's worth of effort. Just devastating.
Ouch. And that's when his spouse apparently suggested maybe getting a, quote, real job.
Huh. Yeah, but instead he pivoted. He became an angel investor. And his personal account is very colorful. He talks about having, and this is a direct quote, as much fun as it is possible to have with your clothes on doing this for the past 15 years or so.
That is quite the quote. It definitely sticks with you.
He went on to found New York Angels, which the book says is the most active angel group globally. He invested in over 90 companies himself with really big exits to Google, Facebook, Amazon, places like that.
So these stories, they really show a common thread, don't they? Many angels were successful entrepreneurs first.
Yeah, often they turn to investing after they've navigated that whole startup world firsthand. They've been there.
Okay, so we know what it is, who does it, roughly. But how do angels actually find these super early stage companies? They're not exactly on the cover of Forbes yet.
Right. The sources outline several key ways. For experienced angels, one of the most effective channels is just referrals.
The word of mouth.
Pretty much. Getting intros from people they trust. Often it's CEOs of companies they've already backed. Because, that trusted source has already done some initial vetting, which is huge.
Makes sense.
And in today's world, with networks like LinkedIn, getting those introductions is often more doable than it might sound. Plus, platforms like Gust allow filtering by referrals, too.
Okay, but what if you don't have that big network yet, if you're just starting out?
Well, you can actively seek them out.
Yeah.
Attending events is a big one. Startup conferences, launch events where companies pitch, business plan competitions.
Places where founders and investors congregate.
Exactly. They're designed for that connection. Also, sometimes ambitious entrepreneurs will just approach angels directly. Cold outreach, essentially.
And what's the advice if you're really new to this whole scene?
The book strongly recommends joining an angel group. It's highlighted as maybe the best starting point if you don't have many startup contacts.
Why is that?
Because groups get tons of applications, right? They have structured review processes, often multi-step, so you get access to pre-filtered deal flow. And, maybe just as importantly, they offer incredible support from other members. The source actually calls it hand-holding while you're learning the ropes.
Ah, learning from peers.
Yeah, it's fantastic for pooling insights, connections, and even capital for bigger deals. And these groups aren't just a U.S. thing. The book mentions them all over the world.
Are online platforms playing a bigger role now in finding deals?
Yeah, increasingly. Reputable early-stage investment platforms are definitely becoming more common. Gust, which David S. Rose founded, is mentioned as a major one. It provides infrastructure for a lot of angel groups, helps them collaborate, track investments online, that sort of thing.
Okay. Are there any red flags in how a company tries to find investors? Things angels tend to avoid?
Yes, the sources do note that most angels and angel groups are pretty wary of companies using paid intermediaries or finders.
Like brokers.
Kind of, yeah. People who take a fee just for making the introduction. It's often seen as a sign the company maybe couldn't build connections organically, which isn't a great signal.
All right, so let's say you've found a potential opportunity through one of these channels. How do you figure out if it's actually worth the huge risk? The book says evaluating startups is more art than science.
That is absolutely true. Predicting success when a company is barely formed is incredibly difficult. There's no magic formula. But the sources are very clear on what matters most.
Okay, what's the key?
If there's one single takeaway on evaluation, it's this. The number one factor, above everything else, is the quality of the entrepreneur, the founder, the team.
So that old saying, bet the jockey, not the horse, that really holds true here.
Precisely. It's central. A great entrepreneur with maybe a good, solid idea is far more likely to succeed than a mediocre entrepreneur with a truly brilliant idea.
Why is that?
Because a great entrepreneur can adapt. They can iterate, pivot if the first idea isn't working, learn, overcome obstacles. A mediocre one,
Right.
well, they can sink even the best concept.
So what makes an entrepreneur great in an angel's eyes? What are they looking for?
Okay, number one, absolutely critical, integrity. The sources call it the sine qua non, the absolute essential. Any perceived lack of integrity, it's an instant deal breaker, no questions asked.
Non-negotiable.
Totally. Then there's passion. The startup journey is just brutal, right? It's a labor of the heart, as the book says. Founders need that deep inner drive to push through all the hard times.
Does it matter how they show it? Like loud versus quiet?
Not really the style, no. It can be quiet intensity or loud enthusiasm, but the passion just has to be genuinely there. And finally, commitment.
Commitment. How do they gauge that?
They use this analogy. Think of a ham and egg breakfast. The chicken is involved, right? But the pig, The
Yeah.
kid is committed.
Okay, I get it.
The entrepreneur has to be that pig, dedicated to this venture until the very end, not someone who's going to cut and run when things inevitably get tough. And that's hard to see if their primary focus seems to be somewhere else.
Gotcha. Beyond the entrepreneur themselves, what other things send up red flags during the evaluation?
Oh, plenty. A major one is just unrealistic assessments across the board.
Like what specifically?
Like wildly overestimating the market size, or underestimating or even misunderstanding the competition, what they offer, their advantages, downplaying how hard execution will be, or the costs, or the timeline.
Financial projections, too.
Definitely. Setting crazy financial projections or having super inflated ideas about the company's valuation right now. The book points out that projections need to be, realistic enough to be believable, not $100 million in sales year one. But they still need to show significant potential, not just like $1 million over 5 years either. It's a balance. Also, a fundamental flaw in the business idea itself, or just a lack of track record or expertise in that specific area.
Competition seems like a tricky one. How much is too much or too little?
Yeah, it is tricky. Angels kind of look for a Goldilocks amount of competition. If the market is totally saturated, that's obviously bad. But if there are truly zero competitors, that can actually be a warning sign.
Really? Why?
It might mean there isn't actually a real need people are willing to pay for. Maybe others tried and failed. So you want some competition to sort of validate the market exists, but you also need to see clearly how this specific company can win, how they can carve out their niche.
And the actual product or service itself?
Well, the product or service needs a clear, focused definition. What problem does it solve? Who exactly needs it? Good product market fit is crucial.
Painkiller versus vitamin.
Exactly. Angels strongly prefer a painkiller, something solving a significant existing problem over just a vitamin, which might just make an existing solution a little bit better. They'll also look at barriers to entry. How defensible is this? How will they beat rivals who might copy them?
And have they actually proven they can sell this thing yet? Or is it all just theory?
That's key. Sales channels shouldn't just be theoretical slides in a deck. Have they actually tested their methods for selling and marketing, even on a small scale? And related to that is the stage of the business. Where is it right now? Is it just an idea? Does it have any initial customers, any traction? Is it generating revenue, even a little? That all affects the risk profile.
The sources mention some pretty specific, pointed questions angels often ask founders.
Oh yeah, they get into the weeds. Questions like, okay, who are your first few customers actually going to be? Name them. Or what's your plan B if this funding round runs out before you hit your next milestone?
Tough questions.
Definitely. Or what's your strategy for APIs, platforms, partnerships? And a big one, how do you realistically see selling this company the exit strategy within, say, the next 6 years? Angels want exciting answers, sure, but answers backed by data and clear thinking.
In all of this rigorous questioning, this whole evaluation process, it leads into due diligence.
Due diligence is absolutely non-negotiable. It's critical. The sources actually cite academic research suggesting that angels who spend more than 20 hours on due diligence for a specific deal actually double their likelihood of success with that investment.
Wow, 20 hours minimum.
It's a benchmark showing the importance of digging deep. It's thorough work covering the market opportunity, the business plan details, the team, the financials, everything.
Okay, let's shift gears slightly. Let's talk about the actual mechanics. How does the money flow? And how do angels eventually get a return or often not get a return on their investment?
Right. The book lays out the typical sort of progression of funding for a startup. It often starts with the founder's own money, their skin in the game.
Can't have that.
Absolutely. Then maybe a small friends and family round, people who know and trust them. Then comes the angel stage, which is what we're focused on. If the company keeps growing and succeeding, they might move on to raise money from early stage venture capital funds, then maybe later stage VC funds, and then only a tiny, tiny fraction ever make it all the way to a public stock offering, an IPO.
Finding a lead investor sounds really important for the founder trying to raise that angel round.
Oh, it's vital. A lead investor is crucial.
Yeah.
That's usually an angel or a small fund who commits to putting in a significant chunk of the money needed for the round.
And they do more than just write a check.
Yeah, they help organize the whole investment round. They champion the deal to other potential investors, try to get them on board, and often they become a key advisor, maybe take a board seat, mentor the entrepreneur. Very important role.
What form does the investment usually take? Is it always like Buying shares, buying ownership?
It can be equity, which means buying ownership, yes, or sometimes it can be structured as debt, essentially a loan.
Okay, let's take equity first. How does that usually work?
When it's equity, investors typically get something called preferred stock. Founders and early employees usually get common stock.
What's the difference? Preferred sounds better.
It often is in certain scenarios. The key difference usually relates to what happens if the company is sold, or worse, goes bankrupt and liquidates. The preferred stockholders typically have priority interest rate. They get their initial investment back before the common stockholders see anything.
Ah, downside protection.
Exactly. Common stock gets the big upside if things go really well after the preferred is paid back. This whole structure, who owns what percentage and what type of stock, is tracked on something called a capitalization table, or cap table.
Okay. And what about that debt option you mentioned?
That often comes in the form of convertible notes, or sometimes SAFEs, simple agreements for future equity. Think of it like a loan, but one that's expected to convert into equity, into ownership, later on.
When does it convert?
Usually when the company raises its next priced round of funding, typically from VCs, the note holders often get a discount on the price per share in that future round as a reward for taking the earlier risk. That's a discounted convertible note.
Makes sense. Risk earlier, get a better price later.
Right. And sometimes there's also a valuation cap on the note. That sets a maximum company valuation at which the note will convert, which protects the early investor if the next round's valuation is, like, unexpectedly sky high.
Are the terms generally different between doing a full equity round versus using these convertible notes?
Yeah, generally. In a priced equity round, all the investors in that round usually come in on the same agreed upon terms, same share price. With convertible notes, a company might raise money from different investors at slightly different times, maybe with slightly different discounts or caps.
More flexible?
Can be. But notes also tend to have fewer detailed rights and protections for the investor compared to getting preferred stock in an equity round. They often kind of kick some of the more complex negotiations down the road to that next financing round.
Okay, so once everyone kind of agrees on the basics, it gets written up in a document called a term sheet.
Correct. The term sheet is key. It outlines the main points: the amount of investment, the type of security, like preferred stock or a note, the valuation or conversion terms, board seats, key investor rights, all the big stuff.
Are they all super complicated?
They can be. The book mentions different types. There are the really long, complex ones that big VC firms often use. But there are also simpler versions designed specifically for these early-stage deals. Gust, for example, developed its own approach: shorter term sheets, standardized documents trying to balance founder and investor interests, and just make the whole process less costly and faster.
Can you give an example of a couple of really important terms you might see in a typical angel term sheet?
Sure. A really common one for preferred stock is that 1x liquidation preference we talked about.
Getting your money back first.
Exactly. Getting your original investment back first if the company sells or liquidates before common stockholders get anything. Board seats are always negotiated, like maybe the founders get 2 seats and the lead investor gets 1 representing all the Series Seed investors.
Control and oversight.
Right. And those investor directors often get approval rights or veto rights over certain major company decisions. Things like taking on significant debt, selling key intellectual property, major changes in strategy, or even firing the CEO.
Okay.
You also often see something called a no-shop provision. Once a term sheet is signed, the company agrees not to solicit or accept offers from other investors for a set period, like 30 or 45 days, while they finalize the deal.
That makes sense. Now, valuation.
Yeah.
That sounds incredibly difficult for a tiny company, maybe pre-revenue.
Yeah.
How on earth do angels figure out what a startup is actually worth?
It is really tricky. And the book basically says it's more of an estimation, almost a negotiation, than a precise calculation. There are methods, though.
Like what?
Well, one method mentioned, especially for pre-revenue companies, is the scorecard method. You compare the startup to other recent similar deals in the same region, and then you adjust the valuation up or down based on factors like the strength of the team, the market size, the product, competition, things like that.
Kind of a relative valuation.
Exactly. Another approach is the VC method, which tries to estimate what the company might be worth years down the line when it's potentially sold its terminal value, and then works backward to a present value. There are also online tools, like the Cayenne Valuation Calculator mentioned, that use questionnaires to estimate a range. But honestly, they often give a very wide range. It just reinforces that art versus science idea. It's partly feel, partly negotiation.
And throughout this whole process, maintaining a good relationship seems important. even if you don't invest.
Oh, definitely. The sources stress that word spreads very quickly within the entrepreneurial community. You want to be known as a fair, respectful investor, even when saying no.
Okay, so let's talk about the end game. What's the long-term outcome here? How do angels actually get their money back? Hopefully multiplied? Or, as we know, often not.
Right. The book provides some pretty sobering statistics that really underscore the high wire act this is. The single most common outcome, unfortunately, is the company just going out of business, failing.
What percentage?
That's about 50%. Half of them just don't make it.
Wow, okay. What's next most common?
Selling the company to a larger business, an acquisition. That happens maybe 20% of the time. Then there's something called an acqui-hire, which is around 15%.
Acqui-hire.
Yeah, that's where a bigger company buys the startup mainly for its talented team, its engineers, rather than the product or revenue stream itself.
Talent acquisition. Got it.
And remember that tiny, tiny fraction that reach an IPO, a public stock offering? The book puts that at 0.1%, basically negligible for most angel investments.
So acquisition is really the most likely positive exit event for an angel.
Yes, by far. An acquisition by a larger company is the most common way investors get a potential return, usually paid in cash or stock of the acquiring company. An IPO is incredibly rare for these early-stage companies.
The other way's out.
Well, sometimes a later-stage investor, like a VC fund, might buy out the earlier angels as part of a larger round, but that's also pretty infrequent. And then, of course, there's the downside. Bankruptcy or liquidation. The company folds, its assets are sold off.
And the money gets distributed.
Yeah, according to that liquidation waterfall we mentioned earlier, creditors get paid first, then the preferred investors get their preference amount back if there's enough, and then if there's anything left over, the common stockholders get the remainder. It's just a stark reminder of the risk involved. Sometimes, during an exit, investors might set aside a portion of the proceeds specifically to incentivize the management team to stay through the transition.
But the book really stresses it's not just about the potential financial return, right? There are other benefits to being an angel.
Absolutely. This is a really key part of the whole angel investor experience, according to the sources. One major non-financial benefit is simply keeping up with the world.
How so?
Well, by meeting all these bright founders, reviewing pitches across tons of different industries, angels get this incredible front row seat to new ideas, emerging technologies, shifting market trends, things they might completely miss otherwise. It keeps them current.
And especially for people who have an entrepreneurial background themselves.
Oh, this is huge for them. Remember, many angels have founded companies. The book notes the typical angel group member might have 15 years of entrepreneurial experience, founded maybe 2 or 3 businesses themselves.
Right?
So angel investing offers them a way to stay deeply involved with entrepreneurship, but without the intense, grinding, 247 responsibility of actually being the CEO again.
Mentorship without the operational headache.
Exactly. Seeing founders navigate challenges, watching them grow, dealing with the stress vicariously, that's highlighted as incredibly fulfilling for many angels. It's a chance to mentor, contribute experience, open doors, but without being personally in the hot seat day after day.
The book also makes a point of placing angel investors within a much broader ecosystem of funding.
That's right. Angels are really just one piece, an important early piece, but still just one piece of the puzzle that fuels innovation.
What are some of the other pieces?
Well, the ecosystem includes things like government grants, especially for deep tech or research-based startups. There are accelerators, like Y Combinator or Techstars, that help very nascent companies get off the ground quickly. Then you have the venture capital funds we mentioned, typically investing larger amounts at later stages.
And they have a different model, right? Managing other people's money.
Exactly. Different structure, different incentives often. There are also venture debt lenders who provide loans specifically to companies that already have venture backing. And then further down the line, you get into private equity, which usually deals with more mature companies.
What about things like crowdfunding? Where does that fit?
The sources mention platforms like, Kickstarter or Indiegogo, but they make a point to clarify that, at least as of when the book was written, around early 2014, these generally were not forms of equity investing.
So you weren't buying shares?
Right. People contributed more to pre-order a product, get a reward, or to support a project they believed in. It wasn't about gaining ownership or sharing in future profits or losses. Peer-to-peer lending was also mentioned, but that was just debt, like a traditional loan with interest. The landscape is always changing, of course, but that was the distinction made then. Equity crowdfunding has evolved since.
And impact investing comes up too.
Yeah, investing with the goal of generating both a financial return and a positive social or environmental benefit. The sources note, though, that it's basically impossible to perfectly optimize for both goals simultaneously. Investors usually need to decide if they're primarily financial first or impact first.
We have definitely covered a lot of ground in this
Hmm.
deep dive. We've looked at what angel investing is, the kinds of individuals who do it, where they actually discover these opportunities.
Right, and that absolute critical importance of the entrepreneur, the jockey, in their evaluation process. We talked about how the investments themselves are structured, equity, debt, term sheets.
And the very real potential outcomes, both the financial wins and losses, and those important non-financial aspects too.
Yeah, the sources really give a candid, warts and all look at the high stakes involved, the long-term nature of it all. It really reinforces why building that portfolio is so necessary and why the quality of the founding team is just paramount.
Understanding this whole journey, really, from a founder scraping together their own savings, their skin in the game, through those different funding stages and the various potential exit paths, it gives you a much clearer picture of the engine that drives so much early innovation.
It really does. It's a world that's fueled by, I think, a lot of optimism and vision, but it's definitely tempered by that incredibly high risk we keep coming back to.
So as you think about everything we've discussed today, all these insights from the sources, here's maybe a final thought to consider. The book is so clear about the daunting odds, right? That 50% chance the company just goes away, completely evaporates, and the very long wait, years usually,
Yeah.
for any potential return.
Yeah.
Given all that, what do you think it really is about those non-financial rewards? Staying connected to cutting-edge innovation, the satisfaction of mentoring founders, maybe just the intellectual stimulation. What makes individual investors decide that those benefits are compelling enough to justify taking on such a significant, undeniable financial risk?